24 hours after the Swiss National Bank stunned the currency markets, we are now beginning to see losses emerge, and it's not so much in the institutional level, it's to do with retail investors who in the past few years have flocked to spread betting firms and currency shops that have been offering these type of people the ability to trade currency risk using high amounts of margin. Joining me now to discuss the likely consequences of what we are seeing is Phil Stafford. What's going on here in terms of the impact?
Well, as you say, they have grown quite rapidly in the last 5 years. Cheaper technology, instant news sites like Twitter have really broadened the appeal. But what we've seen in the last 12 hours or so is the first retail FX brokers around the world. This isn't just a London story. We've had out of Hong Kong, we've had out of New Zealand. Big currency broker, FXCM in New York, said that having trouble with its capital ratios. In the UK, we've had Alpari, another big retail broker, saying it's gone insolvent. Plenty of other brokers also acknowledging losses.
Now, this is a massive market. I mean, according to the Bank of International Settlements, daily turnover is north of 5 trillion. But it's long been dominated by the big institutional banks and investors. But there's been this massive growth in retail interest in currencies in recent years, mainly as a result of very low interest rates and sort of people hunting for yield. I mean, what are the potential ramifications here? Just how big can this get in terms of ensnaring lots of retail customers?
Oh, it could be quite vast, actually. Many of these institutions are actually relatively small, but they do get a lot of customers come in. The churn does tend to be quite high, but they can be, each one could have maybe 170, maybe 200,000 customers registered. Now, the issue really here in Europe is the one related to the leverage ratios, effectively how much the institution would allow you to bet based on the amount that you deposit.
And we're sort of hearing leverage could be 100 times, even up to 500 times in some cases?
Well, exactly. There are no limits within the European rules, and it comes down to the individual company. Some keep it at 100, maybe 200. Others will let investors actually go up to 500, perhaps elsewhere around the EU, even as much as 1,000 to 1, which is ridiculously high. And what that means is, of course, that a small gain, small profit, can be magnified quite dramatically into huge gains. A small loss can easily wipe out the client, therefore you have a lot of churn. An extremely big loss can then even translate to the company itself.
Now, in terms of the regulatory response, it strikes me that unlike the US, where regulators there brought in very hard caps on the use of leverage in retail FX, here in Europe it seems to be almost akin to, they think this is sort of almost like gambling, therefore if people suffer losses, it's part of the sort of discipline of the market. Do you think if the losses accelerate though for retail investors, that regulators may have to change their tune?
I think so. Interestingly, a lot of these rules actually that cover these institutions come under wealth management, as you say. It's on a much more personal basis rather than the market infrastructure rules that would cover elsewhere, the institutions as well, for example. So what you may well have here is probably a review of exactly what these levels are. As you say, in the US, it's 50 to 1. That's brought in by the CFTC. Here in Europe, especially let's take the UK, which is a big centre for this. The FCA have much more focused on the safeguarding the client assets, something that came in after Lehman. There have been a couple of blow-ups since then, but that's really where they're focused. And a lot of these small brokers have all talked about how safe or unsafe that their client assets are.
Right. Great, Phil. Thanks so much. Well, this story is certainly going to continue running, and it's going to be very interesting to see just how the losses spread across retail firms and what the regulatory response will be in what is probably shaping up as one of the biggest margin calls in history, courtesy of a very unexpected and shocking move by the Swiss Central Bank.